What up, Hyperchange? Welcome to another episode. Today we're talking about Netflix's Q4 2018 results that came off last week. Then we're going to do a deep dive into Netflix's business overall. So let's get right into the shareholder letter that came out last week. This is the front page with all of the key metrics for the business. Revenue hitting an all-time record, $4.187 billion in the quarter. I call this TV as a service, basically software recurring revenue that you pay for each month with your Netflix subscription. That was up 27.4% in the quarter. Operating income was $216 million, which is actually lower than Q3 and even lower than Q4 2017 due to heavier related content spending timing. And then moving down to the membership data, Netflix reported ended the year with 139 million paying memberships, up 9 million from just a quarter ago and 29 million from the beginning of the year, and that is worldwide. And then the last interesting number that I want to point out on this main page is the net cash used in operating activities was negative 1.235 billion in Q4 alone. So a ton of spending on content. And so before we get back to the letter, let's take a look at some of this data on Hypercharts. So this is one of my favorite charts, which is showing the total streaming memberships in that blue line. Red is the US, yellow is international, and these actually include free trial memberships. So they're a little bit bigger than just the paid numbers Netflix reported. And as you can see, I love this chart because it shows you how in just the past 4 years, we've gone from international subscribers being, about a third of US subscribers in Q1 2014 to now being way beyond it, sort of an inflection point happening in Q2. And now really just the bulk of Netflix's streaming memberships is almost all coming from international subscriber growth. And you may be like, oh, what's going on in the US? Is this bad? Not really at all. The US has about 60 million memberships overall. And if you think about it, the US only has 300 million people in its entire country. So 1 in 5 people in the entire country have a Netflix subscription. So if you think, I don't even have my own, I use my friends. So if you think about how many accounts like that, basically everyone who could have a Netflix subscription in the US already does. And that is why it's growing so slower. And then that just goes to show you how in the long run, Netflix today, 140, 150 million members around the world could probably hit 300, 400, 500 million members around the globe if its international business does even, half as well in terms of penetration as the US business does. Now, moving on to revenue and earnings, if we just hone in on revenue here, you can see this is, once again, a great quarter for Netflix. If we throw earnings in here as well, you can see that earnings did take a pretty big hit this quarter. And once again, that was because gross profit took a dip this quarter, although it was much higher than in the same period a year ago, Q4. It was down from Q3, and that led to lower than expected earnings, and that was because of the timing of content spend. And then scrolling down to this last operating cash flow chart, which I think really is interesting because it shows you just how Netflix is really going all in on content, and how this last quarter, previously Netflix was spending out 600 or 700 million on content. This quarter they spent almost 1.3 billion in operating cash flow, mostly on content. So a huge investment quarter for Netflix. Now turning back to the investment letter, I love this slide they have of global paid net adds year to date. And so this kind of shows how each year they're adding more and more subscribers than the previous year. Q9 or 2019 Q1 already trending better than the record year in 2018. So that just really shows you the overall core health of the business in terms of memberships. They do have a tiny note in here about saying we just increased our US prices for new members as we did in Q4 in Canada and Argentina and Japan in Q3. The new pricing in the US will be phased in for existing members over Q1 and Q2, which we anticipate will lift ASP. So Netflix, which was announced just a couple of days ago, is raising prices by $1 or $2 for US customers per month. And this has been a playbook in Netflix's business model. And this is why it's such an exciting growth story, is because not only are they adding new members at a rate of 25% year-over-year growth, but they're actually raising the prices for existing members as well. And that combination of, adding new memberships and raising prices is leading to really accelerated revenue growth at Netflix. And this is a trend I think is going to happen for years to come. Like, Netflix's service is provides so much value, almost nobody notices or quits when there is a price hike. So I think Netflix could in the long run, double their prices from here and still have a similar market penetration. In line with these raising prices, their margins are increasing increasing, and they expect their 2019 target for operating margin is 13% versus 10% in 2018. So we're looking at a business with seeing its margin expanding. So remember that chart I showed you where we actually saw the profits and gross profits dip a little bit in Q4. They're saying that's just a one-time thing. They expect operating margins to increase going forward in 2019. Then they talk about a lot about the content in the letter. And one thing that I just wanted to highlight is that they show how this show in Spain, I believe, Elite, a Spanish original, just took off and has had 20 million member households have watched it. And the Instagram following of the actors on that show has generated tremendous traction for them, going from, a handful of thousands, tens of thousands of fans to millions of fans for almost everyone on the cast of that show. And so I don't really know what Netflix is getting at here, but I think it's interesting they chose to highlight how they're a launching pad for new talent. Additionally, they have a note on competition here where they say that in the US, we captured about 10% of television screen time, less than a mobile screen time. So out of 10 hours watched on a TV in the US, 1 hour of it was Netflix. I mean, that is incredible market share and just shows you the domination. And what I really think is even more interesting is how they say that, they compete more with Fortnite than HBO. And so they, this is just to show you how Reed Hastings, the CEO and visionary behind Netflix, thinks about the competition is that, Netflix is competing for your time. You could be doing anything with your time. Are you playing video games? Are you watching Netflix? Or, are you watching YouTube? And I just think it's interesting that they even mention Disney Plus and Amazon Prime and Hulu here and HBO as less of a competition than video games. The last part of this letter, which I think is incredibly interesting, the most interesting insight that came this quarter was the free cash flow and capital structure. So they say, okay, remember our free cash flow was super negative, 1.3 billion, but look at what they say. We expect 2019 free cash flow to be similar to 2018, and then we'll improve each year thereafter. The free cash flow improvements will be driven by growing operating margin, which will allow us to fund more of our investment needs internally. So they're basically saying that, if we go back to Hypercharts and take a look at the operating cash flow on an annual basis, you can see it's been going way negative every year. Now it's almost at negative $3 billion in operating cash flow, but they're basically saying we're going to stay at this level of negative $3 billion for 2019 and then start to reduce it back as we go forward. So Netflix, which up until now has had this guidance of we're just going to keep losing and spending more and more money, and each year they lose a record amount of billions in cash flow, is now saying we're going to stop the bleeding. We're going to lose the same amount of money as we did last year, and then our losses are going to get smaller and smaller going forward, and we're going to be able to fund more and more needs. Instead of issuing debt every year to start funding our content costs to grow our business model, we're going to be able to start to fund those needs internally. So this is a very interesting change in fiscal engineering strategy for Netflix. We're very similar to what Tesla's doing, where they hit a certain scale and they can rely less on outside funding to fund their business model. Netflix is going through the same transition. I think the timing is so interesting because we're sort of getting to this rubber meets the road moment where, for now it's just really been Netflix and I guess you could say Amazon who have dominated the streaming over the top service market. But now coming down the back of their necks is Disney Plus, which is Disney's streaming service, which has been in the works for years, which they've been hyping up. And Disney is betting its entire company basically on this Disney Plus, basically Netflix competitor, and this is launching by the end of 2019 in the US only. And so I just think it's a very interesting timing that we see these other big legacy media companies jump into Netflix's business model about the exact same time that Netflix's business model hits maturity from a capital needs perspective. And so I think Netflix, this to me shows me Netflix is in a much bigger position of strength than at least I previously anticipated, which is going forward, they're not going to keep spending billions and billions and more of the whole. Netflix is essentially saying we've gotten through the worst part of our business model, and now we're going to start to see all this leverage hit, all these raising prices is going to start to really help our bottom line, and we can become a self-funding business. And I think that takes a huge amount of the risk out of Netflix's business model. And let's think about the valuation of this company. So they're worth about 150 billion today at about 330 a share, 450 million shares. You may be saying like, oh wow, relative to 16 billion in sales they just posted, it's like 9.5 times price sales. That's insane. Although the sales are growing at 30%, so that is what it is. But in terms of earnings, Netflix only made $1.6 billion in earnings in 2018. 2019. So relative to that 153 billion, we're looking at like a 95 times price EBIT ratio for Netflix. But what did they say in their guidance? They're expecting EBIT to go from 10% in 2018 to 13% in 2019. If we assume that revenue goes to 20 billion, those 13% EBIT margins, we're looking at 2.6 billion in profits. 150 billion divided by 2.6 billion drops the PE/EBIT ratio to 58 or 59. So in just 1 year, because Netflix is growing their earnings so much, we've seen their PE/EBIT ratio of 2018 go from 95 to potentially 58 in 2019. So this is the fallacy of Netflix. This is why I think people who think it's way overvalued, they don't get why it trades so much, are missing the bigger picture here, which is Netflix is growing like crazy. They're still could triple the amount of subscribers they have globally from 140 million to 500 million. They're going to be able to raise the prices for all of these subscribers for years to come. So the earnings and revenue we're seeing today of the business is just a far cry from the actual earnings and revenue power that Netflix commands. And so that is the discrepancy in the valuation. And then when you start extrapolating how fast their operating margins are going to grow, and then, okay, it's 13% on 20 billion in 2019. Well, in 2020, what is it? 15% on 25 billion. And then we're looking at, 4 billion in earnings. And then, so the further you extrapolate into the future, the cheaper and cheaper Netflix looks. And so buying Netflix today at this price is a bet on essentially on how much they're going to grow. And according to my back of the napkin estimates, like the market is essentially Netflix tops out at around 250 million or so subscribers, is earning, 5, 6, 7, 8 billion a year. That justifies the $150 billion valuation. I think Netflix can get to 300, 400, 500 million subscribers and potentially even raise prices more than the market thinks. If that is the case, then we'd be looking at a company that I think could justify a $300, $400 billion valuation. And so that's how I start to think about the exciting upside of Netflix. But I think we're at a really interesting rubber meets the road moment where Disney is going to be the first real competitor to Netflix besides Amazon. And so now we're going to have this more and more crowding in the streaming space. And will this impact Netflix growth? I mean, it's only in the US. I don't know. But I just think we have this interesting moment where how many subscriptions will you have at once? Are you going to have Netflix? Are you going to have Amazon too? Then you're also going to have Disney Plus. Then you're also going to have Hulu. Then you're also going to have ESPN Plus. Like maybe. But I think at some point, consumers' bandwidth for how many streaming subscriptions is going to get capped at just a handful, maybe 4 or 5. And so now we've only had 2 or 3 good ones on the market for years, but now all of a sudden in the next 24 months, we could have, I heard NBC wants to launch their own streaming service too. We could have 5, 10, 15 solid streaming services on the market 2 years from now. So then what is that going to do to Netflix's growth rate? That is the question. So I don't really know, honestly. I'm going to be following the launch of Disney Plus super closely to see, as always, going to be following Netflix here on the channel. Would love to know what you think in the comments below. What do you think of Netflix's quarter? What do you think of the valuation? This is Hyperchange. Huge shout out to everybody supporting the channel on Patreon. Thank you so much. I'll see you guys next time. Peace.